Good afternoon. My name is Sharma Naidu, metric number 255811. I would like to start with the introduction. Islam as a set of comprehensive economic system that details all aspects of economic life, including government revenues and taxation. Islamic taxes are taxes sanctioned by Islamic law, which are based on the both legal status of taxable land and on the communal or religious status of the taxpayer. Indeed, the revenue that Sharia law has defined includes: first, zakat, which is one of the 5 pillars of Islam. It is only imposed on Muslim and generally described as 2.5% tax on savings, which is to be donated to the poor Muslim and needy. Second is Izya, a per capita yearly tax historically levied by the Islamic states on certain non-Muslim subjects with diminish permanently residing on Muslim lands under Islamic law. The tax excluded the poor, women, children, and the elderly. Third is Kharaj, which is a land tax that imposed only on non-Muslim, but which was later imposed on Muslim as well. The last one is Ush, a 10% tax on the hours of irrigated land and 10% of tax hours from rain water land and 5% on the land dependent on well water. The term has been also used for 10% tax on merchandise imported from states that tax the Muslim on their products. The next part is taxation in Islam. Taxation in Islam emphasizes of taxation on wealth rather than income. The Islamic tax goals are valued encompassing all aspects of human life, including social, political, and economic issues. This is a religion that organizes one's life completely. IBT is a term used for financial transaction that is conducted based on Sharia and according to the certain defined ethical values. Sharia is an Arabic term which means that the way. Sharia governs a Muslim's life in every aspect. Thank you.
And my matrix number is 264452. So now I will continue with the key principle of Islamic transaction. So the first key principle would be belief in divine guidance. The foremost belief of Islamic concept is created and controlled by God. Muslims should follow every command given by the divine revelation through the last messenger, Prophet Muhammad. Commands cannot be violated or ignored on the basis of one's rational argument or his habitual desire. The obedience from servants of Allah is required in their economic activity as well as the collective interest of the society. So the next key interest would be prohibition of interest. Islam forbids all kind of interest or riba, be it for investment or consumption purpose. Thus, all Islamic activities should avoid riba. Instead of riba, financial institution earns profit and fees charged on the financing facilities provided to the customers. Right? The third key principle would be prohibition of haram investment. Sharia prohibits certain type of activities or commodities. Islamic transactions should comply and be consistent with Sharia law. Any enterprise involved with activities or commodities that are unlawful to Islam or harm mankind are haram. So the next key principle is profit and loss sharing. It is a form of partnership where profits and losses of the business are shared among the partners based on their share capital. In Islamic finance, there is guaranteed rate of return. So the last key principle would be real assets financing. Islamic financial institution must trade in real asset or services. This is unlike with the conventional financial institution who trade in money. They buy buy money from depositors and sell money in form of loans. Now we will look into the differences between conventional and Islamic finance transaction. So under conventional, we have property financing, whereby home loan are lumpy assets and the interest paid is based on the loan remaining. The amount deducted for interest decreases over time as the loan remaining decreases. This also means that the amount of principal repaid increases every month. So as for Islamic finance transaction, we have buy bitaman ajil, BBA. This refers to the sale of property on a deferred payment basis. The property chosen by the client is bought to the client at an agreed price, which includes the bank's profit. Alright, next for the lease arrangement under conventional method, it consists of operating lease and also financial lease. As for Islamic finance transaction, we have ijra, which consists of operating lease and al-ijra tumal al-bay. And last but not least, under the conventional, we have conventional insurance, which is associated with riba and gharar, both forbidden by Islamic principles. So for instance, the shareholders own the insurance company in order to maximize profit. And under Islamic finance transaction, we have takaful. Takaful is based on principle of akila, which means that the takaful operator will divide the contribution into tabaru and investments. So that will be it for my part. I will pass it to the next presenter. Thank you.
Hi, myself Ganeshwari Armugam, matrix number 264341, and I'm going to talk about the concept and structures of this chapter. So basically, this chapter talks about the taxes are levied on the wealth of the Muslims, which is in excess of their basic need and their luxury according to normal standards of living. Taxes are only collected from those who were surplus with wealth and nothing from those who have no surplus wealth. Accordingly, there are Sharia index, business structure, sale and purchase structure as well as leasing structure in guiding the collections of wealth as discussed in detail in the following sections. So let us look into Sharia index. A Sharia index of the companies is an index that complies with the Islamic law or the Sharia, or known as the Sharia. Most Sharia indices which have been created based on the existing and underlying index whose constituents have been screened for compliance by a board that is well versed in the principles of Quran. The companies included in the Sharia index are screened on the daily basis, and the procedure have two levels. First one is to exclude all non-Sharia compliant companies. For example, companies that sells pork, alcohol, and gambling, and has gambling. The second level is the amount of debt and cash and the proportion of the revenue that is accrued from the compliant activities is also taken into consideration. Uh, this index can be expanded, and non-compliant stocks in the underlying index are also constantly monitored to check if they stand to become compliant due to changes in their financial ratios. So next is business structures, Mudaraba and Musharaka. So for Mudaraba, it is the partnership structure which involves two parties where one or more investors contribute fund and the other party, normally a financial intermediary, they are called Mudarib. They contribute investment management services to the partnership. And alternatively, a financial institution may collect funds of its customer and forward the funds on their behalf to Mudarib. The financial institution acts as trustee for its customer and assumes the obligation to take all measures necessary to safeguard their interests. Usually, the mudarib receives a fee for its services. This fee may be either fixed sum or calculated in portion of the profit generated. The net profit remaining after deduction of all fees is distributed among the investors in proportions to their contribution. However, there is no guarantee that profit will be achieved, that all of any funds invested will be returned. Sorry. So next one is a musharaka. Musharaka structure is all partners contribute funds or other assets and not only services to the partnership, and all partners may but not required to assume to be an executive position. So this musharaka structure are often used as a long term in constructions like infrastructures. There are two different musharaka structures. One is diminishing musharaka and the other one is limited permanent musharaka. For diminishing musharaka, specific mechanism allow the financial institutions which contributed the funds to reduce its participation in the partnership continuously over time and to ultimately transfer ownership in the assets to the other partners. For limited permanent musharaka, in a structure which has been established for a non-defined period of time and which will be continued as long as the partners wish to continue it. And it is similar to mudaraba. The manager may charge a fee for services rendered. It should be noted, however, that such fee, if any, is rather small if the customer is appointed manager. That's all. Thank you.
Thanks, Tanis. My name is Ujoyi, mention number 259285. I will continue the presentation. We have four types of sales and purchase structures, which is murabaha, istisna, tawak, and buy as-salam. Murabaha is based on cost plus principle, which is widely applied in trade financing. In this structure, financial institution sells the asset and transfer the title to customer. The payment of purchase price could be in deferred or paid in installment. In conventional finance, murabaha transaction could be considered as syndicate among several financial institutions. The relationship between syndicate members does not form part of murabaha, but usually as mudaraba, like partnership structure. Istina concept is similar to murabaha. Murabaha is utilized to fund the purchase of a specific asset, while istina serves the purpose of funding the construction of a particular asset. Previous concept, istisna, is applied in agricultural related business, now expanded to advance financing of construction. Financial institutions acquire the title and then make available to customer, either transferring title to customer against payment of purchase price or based on the leasing structure. Next, tawak. This is a reverse murabaha concept. It applies when the financial institution purchases from third party and sells and transfer on deferred payment basis to its customer. Buy as-salam based on advance payment of purchase price of an asset yet to be manufactured concept. The purchaser could resell at full purchase price and realize a profit. There have several disagreements among scholars on structure. Leasing structure have two types, which is ijara and ijara wa itina. Financial institution acquire a specific asset based on murabaha or istimna's principle. The transaction is agreed among period of time at random payment, and there is no transfer ownership, so the ongoing commercial risk related to this asset, the ijara, are built on financial institution. The similar concept as ijara is applied in ijara wa itina. Customer provide with an additional right to acquire ownership to in leased asset at the end of contractual term. As for the purpose, customer will make into investment account and use the profit to pay purchase price, and the profit realized by investing fund into Sharia compliance investment. And I will pass the presentation to the next presenter. Thank you.
Good afternoon to everyone. I'm Saraswati, daughter of Raman, and my matrix number is 255316. Here I'm gonna to present about the types of Islamic transaction and Malaysian tax legislation related to Islamic finance transaction. There are 6 principles in this Islamic transaction and consists of 4 main features in each Islamic transaction, which is for the each Islamic financial transaction principles, the at least 2 parties in this Islamic contract or transaction are be made, offer and acceptance by both parties like seller, buyer on the purpose of terms in contract. The contract should not be haram, forbidden or offensive towards Sharia. And the last is the subject of the contract must be changed hands upon completion of contract. So, in right side shows that six Islamic financial transaction principles, that is sale based, buy by salam istina, and debt based BBA and murabaha, profit sharing of equity based mudaraba and musharaka, lease based consists of debt based operating ijara and financial ijara, fee based known as agency by wakala and juala, free of charge kat asan, and supporting contract or security kafala, rahnu and iwala. These 6 principles and its features have been used to ensure Sharia compliant transactions and to be reflected an Islamic finance contract in a way for common practices in Islamic financing, financing transactions such as saving or transactional accounts, consumer finance, corporate finance, investment banking, corporate sukuk issuances, including other Islamic financing transactions. Next is Malaysian tax legislation related to Islamic finance transaction. There are certain provisions on Islamic transactions stipulated under ITA 1967 as specified to 5 sections, which is the first is Section 27 Act to interest by applying mutatis mutandis to gain or profits received from Islamic financial transaction, where the to gains or profits received and expenses incurred in lieu of interest in transactions conducted in accordance with the principles of Sharia. And next is Section 28 that exclude any disposal of an asset of lease by or to a person pursuant to a scheme of financing approved by the Central Bank, Securities Commission, Labuan Financial Services Authority or the Malaysian Cooperative Societies Commission as a scheme which is in accordance with the principle of Sharia. And the third is Section 6A3 that consists of rebate, and it be granted for the year of assessment for any zakat, fitrah, or any other Islamic religious dues payment which is obligatory and which is paid in the basis of the year. And fourth is section 18 part 3, that includes of a takaful scheme pursuant, consists of insurance, premium, contributions or installments payable under a takaful scheme pursuant to the Takaful Act 1984. And the last section is section 60AA. Provision of section 60 and 60A shall apply for mutatis mutandis to a takaful businesses carried on pursuant to the Takaful Act 1984. And in this section consists of re-takaful and invert re-takaful, which is mainly for reinsurance and invert reinsurance. For reinsurance, as re-takaful refers to sharing of the risk on an insurance policy with another insurance company, and invert reinsurance as invert re-takaful, broadly defined as a reinsurance as a risk under a policy where the risk insured located outside of Malaysia. That's all for these provisions on Islamic transaction. But there is a specific stamp duty exemption to Islamic transaction, which is first, stamp duty exemptions number 8 order 2000, exempted from stamp duty on all instruments of al-ijrah lease agreement of immovable property executed between a customer and a financier, for example, bank, financial institutions or leasing company, to pursuant a scheme of al-ijrah term financing and facility. The second is stamp duty exemption number 9 order 2000. All instruments of the asset sale agreement or the asset purchase agreement executed between a customer and a bank made under the principles of the Sharia law for purpose of renewing any Islamic overdraft financing facility duly if it is duly stamped. And the third is stamp duty exemption number 38 order 2000, consists of exempted from stamp duty on all instruments of the buy-in sale agreement or the buy-in purchase agreement executed between a customer and a financial institutions made under the principle of Sharia law for the purpose of issuance of credit cards. So, in financial institutions, the consists of these financial institutions licensed by Banking and Financial Institutions Act 1989, Islamic Banking Act 1983, Development Financial Institutions supervised under Section 2 or the Development Financial Institutions Act 2002, or approved institutions by the Central Bank of Malaysia. And the fourth is stamp duty exemption number 2 order 2004. All instruments executed between a customer and a financing under an asset sale agreement or an asset lease agreement under the principles of the Sharia for renewing any Islamic revolving financing facility. And the last is stamp duty exemption number 3 order 2004 for all instruments made by any financier which relate to purchase of property for lease back under the principles of the Sharia, which the financier assume the contractual obligation of customer.
Thank you, Ms. Saraswati Mohan. Next will be tax incentives. Tax intensive across Islamic finance range in promoting Malaysia as an international Islamic finance center are identified below, which is mostly given for a certain period of time and not extended. Number 1 will be exemption from withholding tax. Number 2 will be exemption of real property gains tax. Number 3 will be personal tax relief. Number 4 will be revised rate of re-takaful and inward re-takaful and others. For number 1, exemption from withholding tax, interest income received by non-residents from financial institutions established under the Islamic Bank Act 1983 or any other financial institutions approved by the Minister of Finance are exempted from tax. Profits paid in respect of Islamic securities or debentures issued in ringgit nature other than convertible loan stock, which is approved by the Securities Commission to non-residents, are exempted from withholding tax. This includes non-ringgit instruments approved by Securities Commission or Labuan Financial Services Authority. Similarly, any profit paid on non-ringgit Islamic securities to residents are also exempted if improved by SC or Labuan FSE. Next, for the exemption of real property gain tax (RPGT), chargeable gains accrued on the disposal of any chargeable assets in relation to the issuance of private debt securities under Islamic principles are exempted from real property gains tax. This also applies to the disposal of chargeable assets in relation to sukuk, Bank Negara Malaysia, ijara which are used or to be issued by BNM Suku Berhad. Next, for personal tax relief not exceeding RM5,000 per annum is also provided on Islamic finance courses approved by BNM, Bank Negara Malaysia, or SC, Securities Commission, at local institutions of higher learning including the International Center for Education in Islamic Finance. Next is revised rate of re-takaful and inward re-takaful. The corporate tax rate applicable for reinsurance business is the prevailing rate of 24%, and both re-takaful business and general takaful businesses are considered one source of business income. WEF YA209, the income tax rate of all re-takaful business is standardized at a rate of 8%, and both re-takaful and general takaful business treated as a separate source of income. Inward re-takaful is a separate source of business from the re-takaful business and is subject to income tax at a rate of 5%. YA Year of Assessment 2019, the preferential tax rate for inward re-takaful is abolished. Under the others, pre-commenced expenses of an Islamic stockbroking company will be allowed as tax deduction, which commences its business within 2 years from the date of approval by the SC. Applications has to be received by the SC, which is the Securities Commission, before 31st December 2015. Special purpose vehicles established under the Companies Act 1965 or Offshore Companies Act 1990, which elects to be taxed under the Income Tax 1967, solely to channel funds for the purpose of issuance of Islamic securities, is not subject to tax or tax administrative procedures subject to approval from Securities Commission. Next will be in relation to the incentive given to Islamic product in Malaysia. Few of the following Islamic capital market sectors products and services are given a special incentive. They have few level of incentives. There's a whole book of it. I'm going to just explain the head of it. Number 1 will be sukuk. Number 2 will be Islamic fund management. Number 3 will be Islamic fund management business trust or Islamic real estate investment trust. And the number 4 will be business trust. Sukuk has a lot under it. For example, issuer, the recipient will be issuer of the tax. And the incentives are tax deduction on expenditure incurred for the issuance of sukuk pursuant to the principle of ijara or wakala. Reference legislation, income tax, deduction for expenditure on issuance of sukuk. Next, example for Islamic fund management, the recipient will be fund management company. Incentives as such, fund management companies managing approved Islamic funds of foreign investors are granted income tax exemption on income received from fund management services from the year of assessment 2007 until the year of 2020. The fund must be managed in accordance with Sharia principles and certified by the Securities Commission. Reference legislation, income tax exemption number 15, Order 2007, PUA 199 and income tax exemption amendment under 2006, PUA 104. Income tax exemptions number 6, Order 2008, PUA 225 and income tax exemption amendment number 2, Order 2016, PUA 105. There is another incentive named fund management companies managing Islamic funds or local investors are granted income tax exemption on income received from fund management services from the year of 2008 until the year of 2020. The fund must be managed in accordance with Sharia principles and also certified by SC. Under Islamic fund management, business trust or Islamic real estate investment trust, that's one. Recipient is qualifying company. Qualifying companies managing approved Islamic funds of business trust or REIT, which is real estate investment trust, are granted income tax exemption on income received from fund management services from the year of assessment 2014 until the year of 2020. The fund must be managed in accordance with Sharia principles and certified by Securities Commission. Reference, income tax exemptions, Order 2014, PUA 150 and income tax exemption amendment number 3, Order 2016, PUA 106. Last one will be business trust. Recipient business trust and incentives are such. Trustee manager acting on behalf of a business trust is granted stamp duty exemption on all instrument executed by such trustee manager in relation to this transfer of any business asset or real property to a business trust for the purpose of initial offering of the business trust approved by the Securities Commission on or after 1 January 2013 and not later than 31st December 2017. Reference legislation, stamp duty exemption number 7, Order 2013. That's all from me. Thank you.